we did not see from prior Indian trade deals?
The US-India one is immediate. It is India's most important market. Obviously, that didn't do so well last year, but generally speaking, it's the most important market. The 50% tariff on it was pretty much a big burden for India in terms of export earnings. Obviously, as you know, many sectors are exempted, like tech, ICT, semiconductor, energy, so on and so forth. But the ones that really are important is labor-intensive sectors. And so for those sectors, there's a lot of employment, and that employment is quite important. And that was deeply affected. And it's affected in lack of orders from India, but also losing competitiveness. More importantly, the fact that other countries have had trade deals with the US to lower their tariffs to particularly Southeast Asia to 19-20% level, while India has this huge tariff, means that for investors, they're a bit concerned about the long-term picture of India, right? Unless you're only investing in India to serve the Indian market, you're concerned about your ability to access the US market. And that's also, there's big questions also about these other sectors that are currently exempted, including pharmaceutical, which India cares about. What is that going to be? And I think big question marks about the US-India relationship, whether or not it can draw, a floor to that deterioration. And I think the deal was important in that it releases a lot of that angst. And the relief is immediate. There's a relief is immediate versus, say, the EU FTA, in that it is a liberalization, but it has to wait until the EU side ratify. It has to wait, and everything is in a graduated manner. So even in textile, eventually it goes to 0% to even the level playing field with Bangladesh and Vietnam and so on and so forth. But that'll take like 7 years. So basically, we're looking at medium-term projection. Versus for the US, the relief is immediate. It's within days, you're probably going to get tariffs going down to 18%. And I think for capital markets, it obviously liked it. It liked it for two reasons. One, for obvious reasons, which means you're probably going to get more export income, which means that on the current account, you'll get more income to help the rupee. So that's why the rupee was really happy. On the capital side, there was a lot of negative sentiment about India generally because, even though India growth was very strong, nominal GDP growth was very weak. It had the weakest performance in exports in the region, and that put a lot of pressure on the rupee in the time when the dollar is soft. And because earnings was soft and investors investing in India expect earnings to be really high, right? That's why you invest in a high growth economy. So I think that's why capital markets are really happy, because we're looking at a situation where sentiment is shifting, and it's shifting to be much more positive. So you'll get some capital flow, some portfolio. And on the FDI side, which is basically long-term investors deploying capital to India, they're starting to see stability in that market access to the biggest market is not blocked. Now, I think the second positive element to this, I would say, is that it's signaling a big turn for India. India traditionally, if you read the rhetoric, whether it's op-eds or policymakers, everyone tends to think it's such a big economy. Why should we look outward? We have services that are growing well. We underperform in merchandise trade. Not a big deal because there's plenty of demand within India itself, right? So it's a country that tends to look much more inward vis-a-vis, say, China or vis-a-vis many, many other economies, or particularly to Southeast Asian economies that tend to think we have to grow outward. And I think this shift, I would say after the UK FTA, the EU FTA is a really big one. And the US, US-India deal show that it's actually shifting that mindset. It's shifting that mindset, and I think that's an important one to note, is that it wants to look outward for growth. It wants to introduce much more competition within its own economy. We'll have to wait for the details. We don't have much details other than the headline reduction, how this Russian oil is going to be curbed and so on and so forth. But let's just ignore that for a second. Just think about the big picture, and we'll find out which sectors did India actually open up. Was it able to hold the red lines? And agri-dairy, I would say yes. But within that, there's room to maneuver. Is the big picture that India is willing to open up and willing to add more pressure to the domestic economy, willing to open more competition. And I think that's for every emerging market. That's a difficult question, right? Should we, in our emerging status, trying to industrialize, trying to build our industrial base, protect this market, which is what India did by erecting very high tariffs, right? An example would be the India car market, right? Third largest in the world, 4 to 5 millions per year, but it only imports like very little, from the EU 3,000, I believe the US is 1,000, maybe I don't have the exact number, but you can see the differentiation in how big of a market it is, and for others, what that means. And so that means that it's a pretty protected market because tariffs are really high. So you can think about other sectors where, because of the high tariffs, and I think what does that mean when you lower the tariffs? It lowers the tariffs means that, well, for consumer, you're paying less, right? So your affordability is better. You're paying less for the same item. For the revenue side, there's less revenue for the state, of course, but on a big picture is that there's more competition. So competition can be very good because it spurs innovation and productivity, but it can be bad if it's too rapid and you can't compete, and then your industrial base eroded. And I think India is grappling with this, and I think it's doing so in a gradual way, but in the right direction, in my opinion.